When you're getting a mortgage, you'll hear the term points or discount points. So what does that even mean? Points are simply prepaid interest, and by paying points, you'll receive a lower interest rate than if you didn't pay points. It's simply a way to reduce your rate and lower your monthly payment. The fee is paid at loan closing, not upfront when you lock your rate, and is lumped in with the rest of your standard closing costs and prepaids, things like any lender fees, origination fees, appraisal fees, the credit report, title and escrow fees, any recording or transfer taxes, your homeowner's insurance premium, and any escrow reserves for future property tax and insurance payments. But do you have to pay points? For most loans, the answer is no. However, certain higher risk loans like investment properties can often have some amount of points required, no matter how good your credit is or no matter what kind of down payment. How much are points? Well, points are a percentage of the loan amount. So if your loan amount was, say, $250,000 and you paid 1 point, you would have an additional cost of $2,500 paid at closing. There's not a set amount of points that you have to pay to lower your interest rate. It varies by interest rate and it can vary from day to day. It also varies by loan program. So it's hard to give you an exact amount of paying 1 point reduces your rate X amount. But we can look at the various options of paying points and how that impacts your monthly payment as well as your out-of-pocket costs. Does it make sense to pay points? Well, that depends. The easiest way to calculate this is to look at the payback period. So let's look at a hypothetical example. Let's assume you're buying your own primary residence and don't plan on being in this home for more than, say, 5 years. The price is $500,000 with 20% down, a loan of $400,000. If you took the base par rate or no point rate, let's say it's 6.75%. Your monthly principal and interest payment would be $2,594 a month. If you paid 1 point or $4,000 up front, you could then lower your rate to 6.375, saving you about $100 a month. So if you take the cost of $4,000 divided by 100, you get a payback period of 40 months. Paying 2 points gets you down to 6% and would save you $200 a month, also a 40-month payback. So what you have to decide is, if I'm only going to be in the house for, say, 5 years, do I want to invest that much money up front if I'm not going to recover it until the 40th month? It depends. It might depend on your budget. It might depend on what rate you need to be able to qualify for the mortgage. But if you know you're only going to be in the house for, let's say, 2 years and the payback period is 4 years, then no, it probably doesn't make sense to pay points. Again, once we have your application and we are dialing in the numbers on a particular property, we can then look at point options and see whether it makes sense to pay that additional cost up front to lower your interest rate. But it's not a required cost. If you have any questions about paying discount points or how to structure your mortgage and get qualified, reach out anytime or click the link in bio. I'm here to help. Thanks.